Good morning and welcome to another edition of the Morgans Edward Street Weekly Wrap, week ending 26th of October. Today I'm lucky enough to have Morgans Head of Equity Strategy, Tom Sardell, with me. Today I'll be asking Tom about his thoughts about the market in general in the light of current weakness. Over the past week we've seen equity markets tumble. The Dow was off 600 points on Wednesday night. And clearly it led to some people asking whether we think this is a protracted downturn or maybe just a pause in the long-term equity bull market. So Tom, basically there's lots of things at the moment like the China trade wars with Trump. There's strong US dollars. There's obviously domestic issues as well, like with the loss of the Wentworth by-election by the Morrison government. And then obviously talking about the housing downturn as well, with a lot of these banks moving from interest-only loans to principal interest, and obviously on the back of the Royal Commission, a bit of tightness there in regulation. So let's start at the top. In terms of the trade war with China, do you think this is a sort of a slap on the hand by Trump, or do you think it's a protracted, longer-term thing that we should be really worried about?
Yeah, thanks for having me. Firstly, Brad, you're right. There's a lot going on, and the Trump versus China, or Trump versus the WTO, I guess, members is one part of the equation. In terms of what we think there, our house view is that Trump is lobbing a few grenades to get China and others to the negotiating table, but that eventually there will be some sensible and pragmatic deals done, rather than there being some protracted trade war. So the way Trump goes about his diplomacy, I think there's rightfully reasons to be curious and concerned about how that plays out through the public Twitter sphere and the markets. But essentially we think Trump's just trying to redress the imbalances at play between not only with China and the US, but you would have noticed the NAFTA agreement that was done with Canada and Mexico. There's issues with the European Union about car tariffs that are dramatically in favour of the Europeans. So Trump's going about redressing those imbalances, and I think his way of diplomacy is tricky to digest, but that with all of these countries, including China, I think there'll be a pragmatic solution, and therefore the noise that this trade war creates is actually short-term and perhaps an opportunity when it plays out in equity market volatility.
So in terms of our domestic market, obviously focusing on stocks that have got sort of forward-facing businesses into China, such as TWE, Treasury Wines, Bellamy's, A2 Milk, etc. Is that something to be concerned about sort of more longer term, or is this just a short term?
Yeah, China's really critical for this country, and those companies are able to grow their businesses into that sort of market. I mean, look at the mining companies of Australia. China's now by far our biggest trading partner for hard commodities. Some of the softer and retail-focused products have a big market to gain in China. There will be some hiccups along the way with regulation, and the Chinese are very good at non-trade tariff barriers. So it's a tricky market to navigate, but there's a huge opportunity there for certain companies. The issue we have with some of these stocks you mentioned just there is that the market gets really carried away with some of the growth and opportunity in front of them and tends to price them on extremely extended valuation metrics. And the market tends to get over exuberant, price in too much, reality kicks in, and some of these higher growth, high PE and valuation names get knocked around a bit. So it's going to be a bumpy road with dealing with China, but that's the reality of dealing with it's a less transparent jurisdiction to try and forecast corporate interactions with.
And talking about just following what you said about the high PE sort of names, there's an argument at the moment against growth v value. So obviously a lot of people have been chasing high PE stocks, and it's sort of it's been a self-fulfilling prophecy in some ways, because the market's just kept on leading these results higher. Obviously there's a lot of old hands in the market who are frustrated that the value, the old fundamentals just haven't really been in the fore in the last few years. And clearly that's got to change at some point. Do we see that metric happening in the next sort of short term, next 6 months? Or
the way we look at it, labelling something growth or value is a handy definition to explain what's going on in the market. At various points in the time, we're trying to find the best stocks that have the best opportunity to create value for clients. Sometimes, well, most of the time, they are in that sort of value basket. We do follow a lot of growth stocks, which do actually look more expensive than average, but for good reason as well. So it's a handy definition. The cheapest sort of value stocks out there, including the major banks, Telstra, some of the insurers, the grocers, they're value stocks by definition, but some of those we simply don't think clients need exposure to. So I guess what I'm trying to say is that at any point in time, we're trying to find great ideas. A lot of the time we do like the value names, but often we do find opportunities in the growth segment as well. And I can't answer the question, when are we going to get this wholesale rotation back to value? I kind of think that we're not trying to pick that. At any point in time, we're trying to pick the best stocks that can grow or deliver value for shareholders no matter what. And at the moment, yes, we do have a lot of value names and value ideas, but there's a few growth ideas in there as well that we think can justify their valuations at the moment.
Okay, and look, talking about across the whole gambit of investors and their risk profiles, maybe you can give us maybe your top 3 stocks, maybe which are balanced, or maybe a few stocks which take in a bit of growth, a bit of balanced, and a bit of income.
Sure. Yeah, it's been a huge week, one of those sort of weeks you remember, but we've seen a lot of these sort of bouts of volatility since the GFC. I think there's been 12 or 13 instances of weeks like these since the GFC. I guess across the spectrum, and you should talk to your clients about banks at the moment, it's very topical sector. You mentioned the Royal Commission and inquiry and regulation there. They look to us like the standout part of the market for value, but it's not as if we think clients should be full to the brim with banks. It's certainly an area you do want to keep a close eye on, given your comments around property market, the consumer, and some of those issues. But there's room for portfolios for banks to an extent. Coming through the spectrum, names like in that growth segment that I mentioned, we're very close to names like Reliance Worldwide, Corporate Travel, growing strongly offshore and justifying their sort of more expensive valuations. And we still think those names can deliver. One of the biggest beneficiaries we think from the current volatility, or biggest opportunities we think from the current volatility are commodity producers. So we think the US dollar is at an abnormally strong period. That puts pressure on hard commodities. We think that can unwind. So if you're an owner of a long life, low cost producing asset in Australia, and the major miners stand out there with a great balance sheet where you're generating surplus cash, then names like BHP, Oil Search, Oz Minerals stand out for us right now as the best opportunities in that basket.
Right. Okay, Tom. Look, thanks for your time today. We really do appreciate that. That's it for another wrap. Please feel free to share this video with your colleagues and friends as always, and make sure you like the Morgans Edward Street Stockbroking Facebook page, and also subscribe to our YouTube channel below. Thanks and have a great weekend.